Today, I want to dive into a powerful strategy for established real estate investors, and that is the 1031 exchange. This is a tax deferral strategy that real estate investors can use to sell a property and reinvest the proceeds into a like-kind property to defer capital gains on the initial sale. The reason it's called a 1031 exchange is simply because it follows Section 1031 in the IRS code. Why consider a 1031 exchange as an investor? Well, there are many benefits, and here are a few. Reason number one, you defer capital gains taxes, allowing you to keep more of your profits. Reason number two, you build wealth. By deferring taxes, you can use the full amount of your proceeds to reinvest in larger or higher quality properties, potentially allowing you to increase your cash flow and overall wealth. Reason number three, a 1031 exchange allows for portfolio diversification. You can exchange properties across different markets or asset types, helping you diversify your real estate portfolio. In order to successfully complete a 1031 exchange, you must follow 4 key rules and requirements as laid out by the code. Rule number 1 is they must be like-kind properties, meaning the properties must be used for business or investment purposes only. This does not mean they must be the same type of property. For instance, my husband and I own several rental houses. We're planning to sell those and utilize a 1031 exchange and then purchase a commercial property with those proceeds. Rule number 2 is you have a 45-day identification period, meaning after the sale, you have 45 days to identify up to 3 potential replacement properties. Rule number 3, there's a 180-day exchange period, which means you must close on the replacement property within 180 days of selling the original property. And rule number 4, you must use a qualified intermediary to facilitate the exchange and hold on to the proceeds from the sale until they are used to purchase the replacement property. There are several types of 1031 exchanges that investors can use depending on their needs. So let's take a look at the 4 most common. The first is a simultaneous exchange. This type of exchange occurs when the sale of the relinquished property and the purchase of the replacement property happen at the exact same time. This is the least common of the 4 because it requires very precise timing. Type number 2 is the delayed exchange. This is the most common type of 1031 exchanges, where an investor sells the relinquished property and then acquires the new property within the 180-day period. Type number 3 would be the reverse exchange. This would occur when the investor acquires the new property before selling the relinquished property, but can be very beneficial if the investor finds a great opportunity but hasn't sold their current property. And type number 4 is an improvement exchange, which is also known as a construction exchange. This type allows the investor to use the proceeds from the sale of the relinquished property to improve or build on the replacement property. Hopefully this video has given you a little more insight as to what a 1031 exchange is and why it's a powerful tool for investors. If you're considering a 1031 exchange, it's very important that you find a team to help guide you through the process. You'll want an experienced real estate agent, a tax advisor or your CPA, and a title company who is familiar with 1031 exchanges. If you're not sure where to start, send me a message because I'd love to help.